Hey guys, it's Crossroads here. Today I wanted to talk to you about SoFi, specifically the tech platform and the tailwinds that I think that are already hitting, that we're seeing the first fruits of, that will really propel SoFi onto that dream potentially of that being that AWS of fintech. Now, as a reminder, we're entering a year where things have moved from headwinds to tailwinds for SoFi. It's one of the reasons why I said that it was my number one pick of all the stocks that I watch and care about. There's about 40 or 50 names on it. When SoFi was trading at $7, I said, it's going to probably outperform every single thing else that I'm looking at over this next year. And so far, that's off to a really good start since I said that. We're, of course, settled in the 16s for now. I think there's more to come. So, of course, as rate cuts continue to hit, lending will ramp up, and we'll see that certainly in quarter four. We've seen already inklings of that in quarter three as well. And because of those still kind of high rates, but rate cuts happening as well, financial services will do well on that front. Now, the tech platform is a bigger question, but what is really going for the tech platform is Synapse. So specifically, I just want you to catch up on what Synapse is and what this means for SoFi and fintech, because this does provide some very large tailwinds for SoFi. Synapse is originally a term for the connection between two neurons. And so you can see that layer like in between. It's something that connects two separate neurons and sends signals from one to another. And that's really what Synapse operated as. It was this middleman, this BaaS, that's banking as a service provider between fintechs like Yada, which don't have a banking core at all, and an actual bank such as Evolve in this instance. Now, this is why do customers like Yada, Juno, Copper do this? Well, it's not easy to get a banking license, and it can take years and years, and it's not even possible in some instances. And so instead, oftentimes they'll partner with a bank, and they'll need to build out some APIs. They'll need to bring in a tech team to do that. They'll need to develop that relationship with the bank. That can take years. And when you have a lot of competition, and there's a lot of competition in the fintech space, years means you probably don't have much of a business model. And so to accelerate this, oftentimes they go after a banking as a service provider like Synapse, who has APIs, who can function as that middleman for the FDIC protection and provide those banking elements, connecting that fintech to a partner bank. So far, so good, right? Except not so good. Synapse actually collapsed earlier this year, almost 6 months ago. And as a result, when it collapsed, a lot of people, and Yada was probably the biggest name mentioned, no longer had access to their funds. It turned out for years, Synapse had not kept clear ledgers, that the ledgers that Synapse had versus their partner banks were very different. And so they're still trying to figure out a little bit less than 85 million at this point of funds, who it belongs to, how much it belongs to. For a long time, people's funds were completely frozen and they couldn't do anything with it. And so as a result, there's some greater scrutiny. Now, how should this actually work? Is instead of having a middleman, for SoFi, they bought the Galileo platform. And so SoFi, of course, has payment processing through Galileo. They have, or they are a sponsored bank. They have a banking license, and they have a modern banking core called Cyber Banking Core, rather, through Galileo. And so they can offer all of this as a one-stop shop, which I'm sure you've heard Anthony Noto mention a million times. But so going back, the issue here is Synapse collapsed. It led to a lot of these fintechs just not being able to operate at all. The customers were very frustrated. They even had FDIC labels slapped over their products, just saying, hey, you have FDIC protection. And it didn't really come into play the way that people had thought. So the FDIC is tightening up on fintech in general. This is a headline from earlier this week in Payments Magazine. But if you search for Synapse Collapse or FDIC and Synapse, you're going to get a lot of articles like this. So regulation is not always my favorite thing, but it's sometimes necessary to protect consumers, especially in instances like this. So there's three ramifications that I'm primarily seeing, not just from Payments Magazine, but also others as well, is that the FDIC is going to require a new level of scrutiny for record keeping. Again, that was one of those issues with Synapse, is they kept a ledger, the banks kept a ledger, and the ledgers really didn't agree at all. That's dangerous. Compliance is another issue as well. Annual validation of third parties needs to be done. to actually certify that they are able to meet the customer's needs. And of course, insurance. So they can't just willy nilly say, you know what, we have FDIC insurance through our partner bank. They actually have to prove it. They mentioned here, FDIC mentioned make these customers, or rather these fintechs like Yada, making false statements on the company's website suggesting that they were directly FDIC insured when they actually were not. So this is going to provide some shakeup, and as a result of this, there is a lot of shift towards fintechs partnering with a modern banking core. SoFi is certainly not the only one that offers this, but this is from a press announcement earlier in the year, a couple of months ago, from Galileo when they launched the branded cyberbank core. And so they mentioned like, hey, cloud-based architecture. They not so much here, but they have a lot of APIs that are just there directly. We'll look at that in just a moment. But this offers those same benefits as Synapse. Because a company that's just starting up that is like, you know, we don't have years to go through all these hoops. We don't have years to develop our own APIs. API banking, boom, you have it right there with Galileo. And specifically, you know, they mention a lot of different things that they have here, but federal regulation, a framework to ensure safety and soundness within the banking system. It's like the direct FDIC insurance because Galileo is part of SoFi. And so you have the benefits really without the risk because the middleman is not here. And so this is a look at Galileo's website, specifically for the digital banking platform, the cyber banking core. And there's a lot here. We're not going to go through it. All these links also, if you click, it does some separate links as well. But it's simple, it's straightforward. Dave, of course, has used SoFi for this for a long time as well. And really, that's ideally what happens is if we go back here, this is just directly through SoFi's owned Galileo. There's not a risk of a middleman collapsing and leaving people in a lurch. So, going back, this was one of two headlines related to Galileo this week, and I thought this was particularly interesting. Mesh has been around; it's a small player. This isn't like massive number of accounts, a massive a bit of revenue, but Mesh specifically mentioned that they're teaming up with SoFi and Galileo, and so it's expanding a partnership that they already had. And within this, there was a list of key benefits within the partnership. Let me blow that up. Accelerated product development, that's the APIs, that's being able to benefit, eliminating the traditional inefficiencies between separate providers. It's that one-stop shop idea. Regulatory expertise. This isn't just hoping that the synapses of the world are able to hold it together, but instead understanding that Galileo is a subsidiary of SoFi operating under federal banking regulations. There's not a lot of companies like this. There are other banking as a service providers, and actually the banks are starting to ramp this up as well because of what happened with SoFi and the need for this modern banking core. And operational efficiency, real-time data, automation, central visibility into spending. You're not going to have that ledger issue creeping up where the bank's ledger disagrees with Synapse's ledger, and then the customer is seeing something different. So it's a much better system. And of course, this is the first partnership between Mesh and SoFi that actually has the trifecta of payment processing through Galileo, sponsored bank through SoFi, and that modern banking core, that cyber banking core right there. Now, the other announcement as well this week, this is Plata down in Mexico, and they specifically mentioned that they are using Galileo actually to be able to translate that. They're using Galileo to be able to issue these cards. So another great thing for SoFi. It doesn't relate as much to the cyber banking core, but yeah, these are tailwinds because a lot of fintechs are realizing, hey, SoFi is not it. They might be using a banking as a service that just doesn't have that direct connection to a banking charter, and so there's a very much a need for trust. And of course, the FDIC is going to come out with clear regulations over this next year, which if a fintech is not already operating under a modern banking core, they might be forced to. So those are tailwinds for SoFi that offers a safe, secure service. So I'm excited to see what happens with SoFi this year between the financial services, between lending, and especially with the tech platform. I think this is a year where things continue to perform. My base target is $25 on SoFi this next year. I think that they could go much higher in a bullish scenario, and I think that's more likely than not. But we will see. Now, tell me what you're thinking about SoFi at this point. Is the tech platform actually going to accelerate this next year? I appreciate you letting me know in the comments. As always, thank you for following, for subscribing, and for now, happy investing.